The latest read on U.S. inflation? Cool, like the other side of the pillow. Live from Studio 1 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Zeal. Is that a thing, the other side of the pillow?
Yes, the late, great Stuart Scott. And I'll steal that phrase from him.
Well, all right,
Rest
fine.
in peace, my
I don't know that stuff. Okay, so let's take a look here on where markets are. It is the last day of May. I should put that in context for you because it's been quite a May. The S&P is a little bit heavy here, down by 0.3%. Overall, it's still sell stocks, sell tech, and go ahead and buy bonds. That's still the trade. And even sell the dollar with the exception of dollar yen. That's also getting a bid. So a little bit of safety continues to remain within this market as tech continues to get hit.
Yeah, and all this, of course, against the backdrop of the latest inflation reading. That core PCE data that we got this morning really is proving to be the market catalyst that investors had anticipated, just not necessarily in the direction that they had hoped. The Fed's preferred inflation gauge posting the smallest monthly gain of the year, and a measure of inflation-adjusted spending unexpectedly down. That pullback in consumer purchases is really key to the market moves we're seeing here today. The inflation part of that report was good. Let's make that clear. Good enough to spur a late-month re-up of the global bond rally. A Bloomberg index of U.S. Treasury debt now set to close out May with its best monthly rally of the year. But what's good for bonds, not necessarily good for stocks, nor the dollar, at least when you look at the consumer spending component of today's PCE report. Remember, the disinflationary trend that accelerated last year did so largely because of supply-side shifts. But the latest leg of that cycle, that appears to be tied much more closely to demand, and that adds to the risk of a slowdown in economic activity, a slowdown that really could eat into corporate revenue. And at least for today, it's eating away at an otherwise stellar month for equities as the 5-week rallies in the S&P and the NASDAQ come to an end.
So, Romaine, if I go back to your first point, right, and taking a look at PCE, and the good news in that is that PCE, especially core, came down. And the reaction in the bond market was very clear. It was buy bonds, right, lower yields. This is a correlation going back to about 2018 between the core PCE and the 10-year yield. It is no way perfect at all. But what you can see is recently, whenever you've seen a spike in inflation coming back up, you also see a spike in bond yields. That makes sense, right? Your Fed's going to have to hold higher for longer. But as you can see here, we have seen that decline in core PCE, and you see bond yields starting to roll over. So is this the trend? If inflation continues its trend of decreasing, does that also mean that you're finally going to get yields moving materially lower, and it will be the year for bonds as we've kind of all been waiting for?
Yeah, maybe this is the catalyst for that, maybe not. Let's get some insights out of our first guest. Earl Davis joining us right now to help us kick us off to the close. Head of fixed income and money markets over at BMO Global Asset Management. All right, Earl, I mean, we talk about this sort of little, I guess we'll call it sort of a mini rally that we've had over the past few weeks here. Are you feeling confident at all that this might be that inflection point, that we might start to see more folks embrace the rally, more folks embrace duration, and more importantly, are you going to be part of that pack?
No, I'm not more confident that we'll see lower yields and more people will embrace it. I actually anticipate higher yields. What you just mentioned in regards to the correlation between inflation and yields is bang on, but that's only 1/3 of the equation for yields. There's three things that drive yields. Inflation being one of them, real yields being another, and that's a reflection of expectation of monetary policy as well as growth and risk premium. And that's the most important one that's driving yields higher. And that risk premium is coming in from excess or a lot of supply, treasury supply. One of the interesting things, if you look at bonds this year, look at it from the start of the year, we were at the low yields to where we are now. Each monthly peak roughly coincides with these auctions. Mm-hmm. And it just says it's taking more and more in different type of buyers, economic buyers who need higher yields to buy auctions to get long. Yeah. So the rally after the auctions, not surprising, but it's the monthly auctions and supply. Those are cumulative events that are driving up yields.
Well, let's talk a little bit more about the cumulative nature of that, because there was first some consternation heading into this week with the auctions that were sloppy, to be sure. Coming out of the week, of course, there was a little bit of sigh of relief that it was all over, but we got to sort of redo this again in a few weeks' time here. Do you think those auctions will be as sloppy as the ones that we saw just recently?
It depends. It depends on where the yield is at the time. Each auction, why this one is sloppy, and sloppy is defined by the number of buyers that come in to bid for the bonds versus how many bonds are being auctioned. And it's a lower amount of buyers at these yield levels. It would take higher yields to get in different types of buyers. I'm a prime example of that. Like, we do want to go long duration and yield and rates this year at some point in time. We just don't believe it's the opportune time right now. So a higher yield will bring me into the auction. So it depends on where the yield is at the time of the auction. And if it's too low, then you get sloppy auctions, which just means the future yields will be higher.
Tell me about what yield you'd want to get long duration. Let's just take the 10-year, for example. Yield is 4.5. What do you want to see?
I think we test last year's highs, maybe go slightly higher, but not sustainably. We buy at that level. The reason why we like that level, there's two reasons why you own bonds. One is for the income, the all-in yield, and that 5% last year's highs, it looks very attractive, provides a lot of protection for higher yields. And the other one is for risk-off protection. One of the, the Fed put, as they say, or something, financial stability or instability, people like to buy bonds. One of the things that puts that Fed put on risk is if we get a partial pivot from the Fed. I'm not going to say a full pivot to, saying hikes are possible, but saying we're going to be higher for longer. You're already getting that. At the beginning of the year, people thought we'd have eases by May. And now it's September, December. So if all of a sudden they say we are on hold this year, that kind of implicitly takes away the Fed put a little bit, and then you could get a repricing again.
So are you out of duration altogether and you're waiting for that move higher in yields? And if that's the case, what are you doing with the short end then? Are you shorting the short end?
No, we're long. So we are underweight duration. We're still long, but we're underweight our benchmark duration by about a third of our max position. So we do got dry powder if we do get an ongoing rally. And we are long the short end bonds. There's a lot of protection there. There's two reasons why we like the short end bonds. It's not just the all-in yield, with 2-year rates hovering around, call it 5%, 480, 490. That's very attractive. But also what they call in fixed income, the roll down. That's when if you own a 2-year bond, you hold it for a year, and where are you next year? That is added value. And the best part of the roll down curve in fixed income is in that 1-2 year area.
I'm curious too, Earl, when we start to talk about investment strategies with the presumption of where we're presuming yields will grow, or to a certain extent that they might not go anywhere, that we have a degree of stasis. We've seen that stasis sort of bring people back into the carry trade. I am curious about some of the risk parity strategies, which seem to have fallen out of favor. But there's been a lot of discussion, including a big story that Bloomberg wrote last month, that seemed to suggest more people are now starting to warm up to that as a possibility for the rest of the year.
Yeah, the risk parity, pardon the pun, is the volatility we're seeing in real yields. Real yields have stayed above 2% for a while, and we're seeing some volatility on that side of things. So what happens is the risk parity, and basically for people who don't know, it's basically owning equities, real yields, and nominal yields, and those are all balanced based off the volatility and level. You don't need as much real yields with higher real yields to protect against an equity sell-off, and the volatility is elevated. So for two reasons, you're seeing more pressure, selling pressure on tips. Because people, the risk parity holders, are reducing their exposure to tips despite the 2% real yield. That's why we do feel, we're long real yields, but we do feel there's a chance we could test 250 to 3%. That could be one of the drivers towards higher yields, not inflation, but the real yield.
All right, Earl, going to have to leave it there. Great insights. Always appreciate talking to you. Have a great weekend. Earl Davis, head of fixed income and money markets over at BMO Global Asset Management. As we kick you off to the close here on this Friday afternoon, a closer look up ahead as shares of Caesar Entertainment having their best day in more than a year and a half as Carl Icahn re-enters a big position in that company. All
right, plus we're going to hear from our conversation with Honeywell CEO Vimal Kapur on what he's planning for the industrial giant and why he's not worried about activist investors in spite of the company's underperforming stock.
And from one CEO to another, Pedro Pizarro, the CEO of Edison International, going to be stopping by the program in just a second. His insights up ahead on how AI is driving growing demand for electricity and how utilities are going to meet that demand. Stick with us. This is The Close on Bloomberg.
It is the last day of May. Remember, back a couple weeks ago, the Dow Jones Industrial Average broke 40,000. It's also up 16% over the year. Now, one of its major components, though, Honeywell, makes up about 3.4% of the index, is lagging despite delivering solid numbers every quarter. Romain and I caught up with its CEO, Vimal Kapur, who is celebrating his one-year anniversary in the post on Saturday. And we started by asking him if their three businesses, automation, energy, and aerospace, still fit together.
My near-term priority is deliver the results. We have an earnings guide. We meet or beat it. So that gives us, the right to play, continue to evolve our portfolio, but also be open for all the options. I mean, my job as a CEO is make sure that we drive the shareholders' earnings. That's what I really stand here for. But near term, we have a strong operating system, strong strategy, and I feel convicted we are on the right track.
As you know, there are a lot of investors, activist investors, who, of course, have looked at the model and at least in their minds, think they have a feel for it. I've heard your CFO, as well as other executives at Honeywell, talk about this idea that you yourself are your own activist investor. Kind of explain that.
It's like you always look at it, are we creating value collectively? And ask that question frequently enough and don't wait for an activist to show up. Ask that question, present that proactively to the board, and see what the answer is. And whatever the answer is, run company towards that versus trying to wait for any other scenario. That's what we really mean by we are our own activist.
So if you were your own activist and looking at your stock price versus your peers, what would you tell yourself? Because it's underperformed, and the question for many analysts is for no reason. Because you deliver, you got the margins, you got the growth, you got the earnings, so what gives?
Obviously, I mean, being in this job for a year, it's certainly a disappointment, I would say. But what we are working is to deliver our commitment for this year. And I'm confident that as we deliver our earnings, the year progresses, we'll certainly get the valuation what we are looking forward to.
There's also conversation that the moves that you're doing in terms of divesting some assets that aren't non-core and making some acquisitions like you did with Carrier, for example, almost $5 billion, they're just not enough. They're not sexy enough. They're bolt-ons. You need like something transformational. What do you say to that?
I would say that given we have three compelling trends on which we are aligned to, I don't see a need to add one more transformation. That to me is a stretch argument by making it too general. The question remains valid. What's the next big move in automation? What's the next move in aerospace? Absolutely. And that's what I really work every day to make sure that what can we do organically and what can we do inorganically. And you can expect us to do a lot of work towards that as the time passes by this year and next year. I'm excited about inorganic opportunities in each of the three spaces, and our pipeline is much stronger than it has ever been before. And I do expect that we should be able to announce the right deals during the course of this year. And that will be the true test that we are really executing our strategy and we don't need a transformational deal.
Is that primarily going to be acquisitions? Are there also divestitures that you're also considering?
Some divestitures too. I mean, if I have to truly live to my word of the three mega trends, there are parts of our portfolio which don't fit well, and we'll slowly divest them. The reason we have not been public is to best interest of our shareholders, because by making it public, we won't get the value at the exit point. But it doesn't mean internally we are not doing the work. We are doing the work, and I think it will unfold as the time passes by.
I do want to get your thoughts on the automation business. Investors have been a little bit concerned about how that's lagged the other two major units that you have. I mean, we are at a time of pretty tremendous structural change in our economy, structural changes that I think would be a pretty big tailwind for the automation sector. Why have we not seen that show up yet in Honeywell's results?
Look, our business is, I would say the near-term results are a combination of our automation business, which is short cycle and long cycle. The long cycle portions of automation are doing well because people are building long-term capacity on different end markets. The short cycle is still recovering from the COVID cycle, which can look awkward to say you've been 4 years and you're still talking about COVID. But the stocking impact, the distributors is still playing out. And that's a large portion of our automation business, and that negatively impacts the numbers at this point. But we are confident as the year is progressing, every quarter we are doing better than the previous quarter. And that's our the rubric for 2024, that sequentially we keep improving short cycle every quarter, and we have a strong exit and end of the year, which positions us very well for 2025. So I'm very confident this is not an if or when. We exactly know the different businesses and different cycle they are, and when they are going to see recovery. And we see recovery in many of the businesses already, but it's not all in because it's not a switch. We have multiple businesses and multiple end markets. Therefore, it is going to be sequenced over a timeline.
So the warehouse automation part, you are 100% committed to it.
Absolutely. Today, we are absolutely committed to it. It's a critical need of improving worker efficiency or labor shortages. So this is not about debate of is it a good sector or bad sector. Fundamentally, the value proposition is very strong. It went through the capacity build and overbuild during the COVID cycle because everybody put too much of bet on e-commerce and overbuilt it. So it's going through some correction. So there are the correction pains we saw in 23. We're probably going to experience this 24. But if I take a 5 or 10 year view, clearly there is a clear value proposition on why people invest in it because it gives productivity to them.
Which leads us back just to inorganic growth is what you were talking about and seeing opportunities there. Next year, you're looking at selling that quantum computing business, and that could fetch as much as $5 billion or even more, right? That's a nice hefty sum.
It is.
What do you want to buy? You say you don't have to have a huge transformational deal, but what is on your shopping list?
So our shopping list is bolt-on acquisitions because you want to be thoughtful on how you want to progress your strategy in each of these three mega trends. And the bolt-on acquisition to me is something which attaches with your current business, takes you to an adjacency, and compounds the growth of that business by itself. So acquisition we made on compressor control last year, that was an acquisition into our automation business. It's a bolt-on to that. The acquisition we made for Carrier is a bolt-on to our building automation business. We acquired Civitanavi in Italy. The acquisition get completed in course of the year is a bolt-on to our aerospace business. If you see the trend line, we are very purposeful to do the bolt-ons, and we stay on course for three of our mega trends. So we are not doing some random things which make no sense. So everything you will see moving forward will following the same trend line.
Is that going to be enough to get your growth engine really started?
Absolutely. I mean,
when is that growth engine going to rev up hardcore?
Look, our commitment to our shareholders is 8 to 12% earnings growth every year. And what I need to work on is when you look at a 5 years or greater horizon, are we capable of delivering that every year on year? And so I look at organic growth and inorganic growth in combination of that, and are we really prepared for preferably double-digit earnings growth? And that's what I'm here for.
That was Honeywell CEO Vimal Kapur joining us in the studio yesterday. I mean, my takeaway from that was like, I get your points, guys.
Yeah.
Give me some time. I'm doing it my way. It's going to pay off in the long run with consistent growth, but clearly, investors don't buy it yet.
And we know how this goes, right? I mean, look, he's only been there a year, but investors start to get antsy. They want to see the results. He's got to show it some sort of modicum of growth, or at least some sort of pathway to growth. And he's probably going to have to do it relatively soon.
I mean, that's what's so frustrating, I'm sure, is because the numbers are really good, particularly in the aerospace division, which is good for most of the companies across the board. Yet the underperformance with the likes of GE is pretty staggering.
That's the other thing. I mean, we asked him a lot. He was kind of dismissive of the whole idea of this sort of breakup of the conglomerate model. He even kind of said that we're not really a conglomerate. They're just kind of basically just a collection of operating companies, which I guess technically is true. But, so is GE. I mean, that's what a conglomerate basically is. But he seems to stand by that. And I don't know, maybe investors will agitate a little bit more for something like that to be, split up.
Yeah, and I appreciate that this chart is going to give everyone a headache. All it means is that the white line is Honeywell.
Ooh, okay.
And then everything else is like
1,
GE,
2,
for example,
4,
3M,
5, 6.
Eaton,
There's 6 lines.
Edison.
You know what would have made that chart if we put a 7th line on there?
You think that would have done it? That would have made it crystal clear for you? Okay, cool. We're going to do it. 7 lines.
We got to get serious here. We got a lot to talk about, including, of course, the big political news of the day, the ramifications of Donald Trump's guilty verdict and his response to the justice system. That conversation coming up after the break on The Close on Bloomberg. All right, welcome back. Of course, all eyes still on former President Donald Trump. Today, we heard from the current President Joe Biden responding to Trump's claims that his trial was rigged. Biden calling it irresponsible and that no one is above the law. Joining us for more insights here on yesterday's verdict is Rick Davis, Bloomberg Politics contributor. Rick, there's been so much talk here about sort of what this trial was going to mean for Donald Trump, the man, Donald Trump, the business. What impact, if at all, is this going to have on Donald Trump, the candidate?
It adds another vulnerability into the entire campaign. This has been a roller coaster of a campaign. Every time we think we know what's going to happen next, there's another indictment or now an announcement of a new debate just recently. So this is a history-making campaign that doesn't really follow any sequence of events of previous presidential campaigns. So I think anybody who is going to want to predict the future on this thing is at his own peril. So I think what we know today is this isn't going to be helpful other than fundraising. Donald Trump just raised $34.8 million in 24 hours with this verdict. So it helps him with his fundraising like other indictments have. But the question is, does it create any doubt in voters' minds? And that's actually what's more important.
And Rick, when do you think we're going to get a real idea of that? And is it any conviction, or is it depends on the actual conviction? Like a Georgia conviction would be different than the hush money trial. When are we going to understand that dynamic?
Yeah, most of the pollsters that we've been watching have basically given voters a choice, and they're about what kind of a conviction would motivate them to not vote for Donald Trump, and it's really fallen into a basic concept that if it's a felony, if it's a conviction, it's a serious crime. There's a group, maybe 15 to 20% of Trump's voters who would say they'd reconsider. And I think that's where everyone's going to be watching for the next few weeks. There'll be some polls taken. Marist took a poll just a couple of days ago that said, 17% are less likely to vote for Trump if he's convicted.
I'm going to ask you a question, Rick, that you probably can't answer. But, I mean, you've been a Republican consultant for years now. You worked in the White House, I think, back in the Reagan days. Is there a sense here that there would be any hope for the Republican Party itself to get off the Trump train and find a different candidate? Or is the Republican Party now Trump's party solely?
It's not Trump's party solely, but it is Trump's party. And it is a different Republican Party than the one that I worked in from Reagan in 1980 to, John McCain in 2008. This is a Republican Party that's primarily non-college educated white voters in rural areas. And they love Donald Trump. And when he says to them it's rigged, the trial, they believe him. This is where they get their news. And so it's not likely to change significantly. But the Republican Party I know, big parts of it, suburban voters with college educations, they're Democrats now, and they're voting for Joe Biden.
Well, that's really interesting. Hey, Rick, we really appreciate it. It was good to catch up with you. Bloomberg political contributor Rick Davis joining us. All right, coming up, we're going to talk to Pedro Pizarro, president and CEO of Edison International on AI and utilities. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Zeal. And no doubt a lot of hay is made about NVIDIA and how it contributed to the S&P this month and how it's really powered the S&P for the whole year.
Yeah.
Do you know that there's a stock that actually has outperformed NVIDIA in the past year, and it is a power company?
Oh, so it's not Boeing?
No, definitely not Boeing. It's definitely not Lululemon.
Okay. I saw this too. I mean, a lot of people are making a lot of hay about this. Vistra it was the second best performer on the year, and I think it's also like second best performer in the quarter and the month, the week, and forever.
Yeah. And you can see this chart right here. You're looking at utilities indexes, the white line, but Vistra is outperforming on a normalized basis NVIDIA. Now, obviously that they're linked.
But
in
well,
some
that's what you're going
ways.
to say. They're kind of rallying for the same reasons, more or less, right?
Sure. You need a lot of power for the AI data centers and the data centers in general. And you power companies like Constellation Energy. We spoke to them as well as Vistra. They're not necessarily utility companies. They're straight up power companies. They're the guys that are on your speed dial if you're a data center.
Yeah. All right. And they're on my,
They're on your speed dial?
Yeah.
Okay, cool. You have a data center. It's fine. All right, and speaking of, utilities in general are the best performing sector this month, behind tech, and the third best this year, outperforming the broader S&P. One stock, though, that hasn't had the same run as Vistra is Edison International. It's an integrated electric utility based in California. Now, joining us to discuss is Pedro Pizarro, president and CEO of Edison International. Pedro, it's great to get your perspective with us. Thank you for joining us. on a Friday. Why haven't you enjoyed the same kind of rally that, say, Vistra has? Is it a California thing? Is it a utility versus a power company thing? Where is your outperformance here?
So first, Alex Romaine, thanks for having me on. Always great to be here. Last year, Edison actually was the second highest performing stock in the Philadelphia Utilities Index. And with us, we have the unique circumstances of having come through the issues of the wildfire concerns in California. So that has definitely been a bit of a holdback on our valuation. Last year, we recovered about half of the gap that we were carrying compared to our peers. So we have a really strong 23. We're doing okay this year as well. And most importantly, we continue to be very committed to our 5 to 7% EPS guidance, growth rate guidance that we've given investors out through 2028. So lots going on here in terms of investing in the grid, repowering that grid, hardening it against climate impacts like wildfires. And certainly, we're tracking load growth, not only from AI, but here we're seeing a lot of electrification already underway.
So let's break that. There's a couple of things to break down in there. Just in terms of, say, the load growth and the expansion when it comes to AI. Like, does NVIDIA call you on a speed dial directly? What's that link there, and what's the growth that you're truly expecting?
Well, I will say with NVIDIA that, as you might know, I'm chair of EEI, the Industry Association for Industrial Utilities, and we're really happy that Jensen Huang is going to be joining us at our conference coming up here in the next month in Las Vegas. So I'll get a chance to moderate the discussion with Jensen. So absolutely, we are, as an industry, in touch with not only the chip makers, but the data center providers and the broader set of customers. And I think the big focus is on how do we make sure that at a national level, all the way onto a local level, we have both the supply available, but importantly also the grid available to interconnect not only AI-driven data centers, but also the manufacturing facilities that have come back to the country through the success of the Bipartisan Infrastructure Bill and the CHIPS and Science Act. And in places like California, again, the early days of some pretty massive electrification we're seeing beginning with transportation, and we think that's coming to buildings too.
Well, so Pedro, this all sounds exciting, but it also sounds expensive here. What is sort of the investment commitment right now to achieve that, or at least the potential investment commitment that you think you might need?
Well, if you look backwards over the last decade, EEI members have invested $1 trillion in our systems. Last year, it was around $168 billion. Moving forward, there is a big investment need, but importantly, it comes with some real benefits, right? And it's not only the benefits of enabling the transition across the economy to use AI, but it's also investments to make the grid ready to support the electrification needs for decarbonization over the longer term. We've done analysis for the state of California, which is instructive, so the world's 5th largest economy. And we estimate that in California alone, over the next 20-some years, up to 2045, when the state has a net zero target, the state will need to see something like $370 billion investment just for large-scale renewables and storage and the grid to interconnect it. But really importantly, Romaine, we see that has a benefit not just for net zero, not just for serving load, but we see other benefits, including air quality improvements, and maybe most importantly, the pocketbooks. Because electric technologies are more efficient than today's fossil fuel technologies, we see our average customer actually spending 40% less on their total energy bill in 2045, electric plus gas plus gasoline, than they do today. So there's lots of benefit from that investment.
Is sort of one sort of renewable energy source, alternative energy source, going to dominate over the other? Is there something we should be looking a little bit more closely at?
I think we need all the tools in the toolbox. And so today it's renewable technologies like onshore wind and solar and geothermal. It's carbon-free technologies like existing nuclear. In our analysis, we estimate that to serve will be at least an 80% increase in load, and that's probably an underestimate. So I think AI will push that even higher up. 15% of the resources we'll need in the future are not technologically ready yet today. So we're also excited about new generations, new technologies, new chemistries for batteries going beyond lithium-ion. We're excited about small modular reactors for nuclear, offshore wind, new geothermal technologies that use horizontal drilling techniques. So a lot of excitement around the supply side, excitement about new technologies for the wire side, as well as excitement about the technologies that customers will be using with all that clean electricity.
All right, Pedro, got to leave it there. Great to catch up with you. Pedro Pizarro, President and Chief Executive Officer over at Edison International. And Alex, we've been talking about this a lot, and I'm sure we're going to be talking about it for months, if not years to come, really about the power demands. And I know we only talk about it from the kind of this perspective of the potential benefit to companies like Edison and others, but this is going to be a lot on our energy grid right now. And we know, particularly in certain states and how fragmented it is, certain states aren't ready for this.
No, and California, for example, just imposed the country's highest monthly fixed utility fee. Good for Edison and those companies like PG&E, because then they get the money they need to invest in the infrastructure to support the demand you're talking about. But what does that mean for us?
How do consumers feel about that?
Higher bills.
Yeah, exactly.
By a lot. There's no way we're going to get around it.
Yeah, and at some point it's going to become a political issue where politicians are going to have to explain why this AI revolution that is leading to a higher bill for you is somehow going to benefit you, even though most people are going to look at it and be like, how?
Or unless it's subsidies. I mean, it has to give. Like, how do you make the investment without actually spending the money if you're a regulated utility? So, interesting.
Yeah, absolutely here. All right, we're going to continue our conversations coming up here on The Close. A lot to cover, including a closer look at Caesars, biggest mover right now in the S&P 500 on the back of reports that Carl Icahn has taken a stake again in the company. We're going to have details about what the billionaire owns and what he plans to do. It's our stock of the hour, and it's up next on The Close on Bloomberg. All right, time now for our stock of the hour. Watching shares of Caesars Entertainment, biggest gainer in the S&P 500, after a report by Bloomberg saying that billionaire Carl Icahn has taken a shine to the company once again, amassing a sizable position in the hotel and casino operator. Chad Biden joining us right now, senior gaming, lodging, and theaters analyst over at Macquarie. He's got an outperform rating and a $55 target on the shares. And Chad, I want to sort of read to you the response that Carl Icahn gave one of our Bloomberg reporters when asked about what was going on. He said, quote, "There's absolutely no activism contemplated in Caesars." You buying that?
I am. I think it's the standard rule of invest in what you know. And interestingly enough, so our price target here is $55. Caesars stock is down 55% since COVID. The S&P is up 55%. So I just look at this as a value opportunity. I think Carl knows the space. He's a familiar face. He's made a lot of money historically in the gaming industry. He knows the management team well. I don't think there's much you can do here. I just think he views it as a value opportunity at a time when investors are doubting Vegas.
In that same statement that he gave to Bloomberg, he kind of talked about the previous iteration of Caesars and sort of his activism and sort of orchestrating the Caesars and El Dorado bid here. When you look at what the company has become, Caesars, and you look at where it could potentially go here, what exactly is the tailwind here for Caesars and maybe for its peers as well?
This is a highly leveraged company. When El Dorado and Caesars came together, they had essentially a 5-year plan in terms of deleveraging. And they're slightly behind those plans, but I do think by 2025 or 2026, they'll be in a much better position. So they did sell off a lot of the real estate. They still own some here. And when interest rates come down, I think there will be more opportunities to sell to some of the big triple net lease REIT companies and get some value there. But I think ultimately you get past some of this CapEx, you get past some of these negative digital returns because they're trying to take market share from FanDuel and DraftKings, and that's just going to take another year or two to kind of swing that. And then you kind of get into free cash flow harvest mode. We're probably looking at the middle of 25, maybe early 26, where you can get into this $6 to $8 of free cash flow. And if you put a standard 10 times multiple on it, that's kind of where we see, mid 50s up into the $60 level. So I just think we need a little bit more time, and Icahn is seeing the opportunity here when investors aren't.
Chad, how sensitive is Caesars to the overall economic environment, or can it be somewhat immune?
The last downturn was dramatically negative for Vegas, right? Revenues were down about 18%. It was a little bit of a different time. Outside of Las Vegas, gaming revenues were down 7 to 8%. So the regional market was very recession resistant. Vegas was hit much harder. I think Vegas is a different place now in terms of the diversity of people that are going there, business travel, sports, events, entertainment. Caesars has done an incredible job improving margins. I think that's one of the things we're keeping an eye out. Their margins are close to 50%, and they're up almost 1,000 basis points since pre-COVID. So they've kind of done all the tricks that you can do in terms of reducing labor or optimizing the business model. So if we see a downturn here, I don't think it's going to be as harsh on this company. That said, there is a lot of negative operating leverage to all of gaming in general.
Hey, Chad, really appreciate it. Thanks a lot for jumping on with us on this Friday. Chad Bayonne joining us over at Macquarie. I'm interested to see, though, so it's an operational thing. They got to get rid of the debt. I get that. But then in terms of, say, getting market share and really growing that revenue, who do they steal from? Like,
that's a good question.
Is it DraftKings?
I don't know. I mean, I feel like they're almost two different customers to a certain extent, but I'm obviously Chad's the expert on what goes on in that space. I'm more intrigued, honestly, by just Icon himself. I mean, what is he, 80 something? I lost track, and he's still at this.
I mean, why not? Like, what does he have to lose at this point?
No, retire, go hang out with your grandkids.
I don't know. I mean,
go fishing.
Herbalife is over, so now he can just enjoy. Yes, the Herbalife.
Yes, remember.
We love it.
Love it. Us about Ackman.
All right, coming up, we're going to count you down to the closing bells. Kim Forrest is founder and CIO over at Bokeh Capital Partners. We're going to break down these markets. Tech underperforming, but I got to say we are well off.
I don't think I will
the
be doing
session
this
lows.
at 80.
You don't want to be anchoring at 80?
I'm not sure I want to be anchoring at 50, but that's a whole other topic.
Man, I'm going to be here for the next 40 years. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele here on the final trading day of the week, Alex, and the final trading day for the month of May.
There was a lot of stuff that happened this month. I mean, the S&P hit records.
Yeah.
The Dow went through 40,000. You had party hats.
I wore that hat for a whole day and a half.
You did. The Russell 2000 outperformed the S&P for like 5 days.
Yeah.
I mean, stuff happened.
Yeah, it was a very busy month, and a lot of questions are we going to get a repeat of this in June, or is this it?
And is it as Nvidia goes everything else, or the fact that not that many stocks are over their 50-day moving average for the S&P, but the overall index is there catch up potential? You could look at it either way.
Yeah, well, when you look at the monthly performance on a sector basis, I think you may have a little bit of an answer as to wherever you go. I mean, a lot of folks piling into utilities, some energy stocks, and maybe the bloom coming a little bit off the rose when it comes to the tech trade. Kim Forrest joining us right now. She's a founder and CIO over at Bokeh Capital Partners to help us count down to those closing bells. And Kimberly, I do want to start off here with that tech trade. We've seen it wane just a little bit, though. There's always that asterisk there that for a lot of folks, depending on what your entry point is, you're probably sitting on some pretty healthy gains here. But there are a lot of questions as to whether that trade has run its course. Are you still seeing something left?
Well, I think if you're looking at any other stock other than Nvidia, maybe. Nvidia did suck a whole lot of air out of the tech space while making tech go up. So we can't really disparage it. But I think if you're planning for a longer kind of term than the next 12 months or 18 months, you really should look outside of Nvidia and know that AI is going to be a thing probably for the next 10 years, because it's going to take much longer to develop than any investor really cares to think about.
It is going to take time, and you should know this better than anyone, given your background in computer science and math. And we get to this idea, though, this week we kind of saw why that trade, at least a certain element of that trade, might be premature. We saw that with Dell, which, of course, rallied hard, and then when they came out with earnings, there was nothing there. It doesn't mean they're not going to benefit from AI, but at least in the short term here, those numbers just aren't showing up, and it may take a little bit while before we start to see them show up.
Right. And I think it's really confusing to investors that play around with like version 0.1 of something, which I think is what we're really at with ChatGPT. It can be used, but you really have to double and triple and quadruple check the data that you get from it. So is it really that productivity enhancing? I don't know. Maybe if you suffer with sentence structure, it could help you out. But come on, you know what I'm saying here. But, you really have to watch AI because it's intelligent, but artificially so. So it is not guaranteed to be right. I know I'm disparaging it, but I do think that when used correctly, and that's when it's double check, triple check, quadruple check, and then blessed and ready to go, it can add productivity. but the magic of using it right now isn't necessarily productive.
So based on that, I know you don't own NVIDIA, but you do like areas in tech that you do think have potential. What are some of your top names there?
So because I was an AI-oriented software developer back in the dark ages of the 1990s, yeah, we had computers then, I know that all of this training of any kind of serious AI takes a ton of data. So we really like Micron. It really competes on solid state memory, which is going to be used extensively in the world to store all this data. And then it uses DRAM, which we think is very useful just at the end node computers. And I think there will be more of those. So I think for the long haul, we like Micron because it's data that drives AI.
Do you play, we were just talking to Edison International earlier. Do you play the utility/power theme when it comes to AI too?
A little bit. We have a utility pick in our sector neutral portfolio because, well, utilities are included. But here's the thing, it's going to be very expensive to build this out. And it seems like a lot of the bigger data centers have figured out where in the world they have cheap electricity. And I don't know, even though people think it's going to be, I don't know, the upper part of Maryland outside of Washington, D.C. is going to be one big data center. I'm not sold on that. If you look where Microsoft and Google have placed their data centers, you'll see they're next to cheap power. And I think cheap power will always win in this battle.
Interesting when we look at sort of the trades that we saw this week, Kim. I mean, we did see the bloom come off the rose just a little bit in the tech space, particularly with software companies, one of the worst of the S&P groups on the week. One of the best performers, though, on the week was, believe it or not, in the consumer space, consumer discretionary, particularly in apparel and retail. And I am curious as to whether, A, you think there is a little bit more life in that trade, a trade that I think a lot of people had abandoned just a few months ago.
Yeah. Well, one of the biggest things that you look for if you're going to play retail is a change in shape. And we have had skinny pants for the longest time, at least women. We're not getting into the men's skinny pants thing. Huh?
It's wide leg now, Kim.
I said
it's
speak for
leg.
yourself. I've never been able to fit into skinny pants, but sure.
Well, you know what I mean. That silhouette, right? That is closer to the body. Well, for whatever reason, large flowy pants have captured the attention of teens and 20s, and God knows we have the influencers out there. And it looks like that change in shape could drive a lot of people to buy stuff. And I think that is a great moment to try to pick some names and decide who might be the new winner in a new shape. And we all get bored. I hate to say this, even people who profess they don't like clothes, if you're wearing the same style over and over again, it can lead to boredom. And I think these trends are good for not just retail, but your mind as well.
Yeah. All right, Kim, I'm going to have to leave it there. Always great to talk to you. Have a wonderful weekend. Kimberly Forrest, founder and CIO over at Bokeh Capital Partners. And speaking of that retail trade, I mean, you had some pretty impressive gains this week, Alex. I mean, Deckers was up 21% here over the last 5 days. Ralph Lauren staging a good comeback, up about 10%. And then you even had some names like Tapestry as well as Lululemon actually get pretty decent bids on a weekly basis.
Gap also.
Yep.
Gap was doing really
Absolutely,
well.
yep.
And I think we've been talking about this for a while with retail earnings. Like if you have the right product at the right time and you manage your inventory, you can do quite well, even if the consumer is actually slowing, which I find to be quite interesting.
Yeah, and it's funny too, all the talk about how these styles and silhouettes change. It's kind of funny that we're going back to maybe some of the older styles. I don't know if that benefits some of those companies. I mean, we interviewed Abercrombie & Fitch CEO earlier this week. They've kind of made a nice comeback. Gap, you mentioned, seems to be trying to turn itself around. So I don't know, everything old is new again.
Now.
Is it?
Remember, Gap was cool in the beginning, and then it got lame, and now it's cool again. Like, who would have thunk that? I like the wide legs, though. I'm very happy with wide leg jeans. We don't have to do the taper anymore. I appreciate that.
Okay, we're going to have to agree to disagree on that one as we move closer to the closing bells here on the final trading day of May. Stick with us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. We're joined today by Carol Massar and Tim Stenovic as we welcome our audiences across our Bloomberg platforms, television, radio, and our partnership. Yeah, that is right, Carol Massar. Our partnership with YouTube here on the final trading day of the week.
So much for sell in May and go away, right? Look at this. First of all, we're having buying going into the weekend here. So we're going to finish, looks like, at our best level on the S&P 500. But I'm looking at gains in the month of May for the S&P, more than 4.6%. The NASDAQ 100 up about 6%. Even the small caps up about 4.8%. So we have seen investors in a big way come back into the equity trade.
Still, though, seeing some mega cap tech stocks dragging down the index in the S&P 500. Amazon, NVIDIA, Broadcom, Microsoft, Netflix, Tesla, all weighing on the index, even though it's higher now, Alex.
All right, this is all really cool and fun, but Petco is ringing the closing bell on the NASDAQ, and they're puppies.
Oh,
they're puppies.
yes.
Do you guys see the puppies?
No.
I'm sorry.
Not yet. We'll see them soon.
Do we care about anything else but the puppies?
No.
They're so cute. How can you not be in a good mood? Anyway, stocks off their lows.
So
NASDAQ
the marketing
almost flat for the
decision,
day.
you're saying the marketing decision worked on you?
Oh my
for
God.
them to bring puppies.
I mean, yes, come on, you bring puppies?
Is that why people are buying into the close?
Sure.
Okay.
Yeah,
I'm in.
Why not?
Yeah.
But buy into the weekend because they're puppies at the NASDAQ.
All right, we talk about sort of what went on the day and more importantly for the entire month here as we close it out here. A relatively tepid day, but I think as Carol was referencing here, we were in the red pretty much across the board for almost the entirety of the session. But as we get these closing bells, you hear them in New York. One of those bells, at least on the NASDAQ, being rung apparently by puppies. We should point out that stocks now moving into the green to end out the day, the week, and the month. The Dow Jones Industrial Average up about 1.5% here on the day. For the month, that's going to be good enough for a gain of more than 2%. The S&P 500 up 0.8%. That's a 5% gain for the month. The NASDAQ composite, we'll just call it unchanged on the now. It's going to be down basically about 2 points, so in the red on the day. But for the month, it is nursing a gain of about 7%. And the Russell 2000 also in on the action on the day here, of 0.6% gain here on the day and a 5% gain on the month.
Maybe they have some thoughts on the dogs of the Dow. You know, maybe we need to reach out to them and just ask them about that.
Nice.
Yeah, I know. Kind of lame. All right, S&P 500, folks. Most names in the index definitely higher today. 427 to the upside, 75 to the downside, and Alex, one unchanged.
I mean, really, let's take a look at the IMAP here within the S&P. Information technology now totally flat here on the day. Really impressive. Just in that last half hour, how we really made up some of those losses. But energy is the best performing sector within the S&P, despite some waffly prices within oil. But then you have real estate, and then you have utilities, and that's really the bond story. As yields move lower in the bond market, those sectors become more attractive.
All right, let's get to some of the individual gainers. Gap among the gainers in today's session, folks, pretty much finishing at its best levels of the day, just shy of a 29% gain. Eye-popping earnings report that showed the overhaul by the company's CEO, relatively new, Richard Dixon, known to the Mattel universe, who really helped revitalize the Barbie brand at Mattel. Well, he seems to be revitalizing Gap in a big way, really kind of embracing celebrity marketing. We had Anne Hathaway wearing a Gap dress to a red carpet event. We had folks at the Met Gala wearing Gap items. So anyway, you see investors certainly liking their results. Caesars also popping in today's session, off its highs, up almost 18% at its highs today, but finishing with a gain of about 11.6%. Bloomberg exclusively reporting, that Carl Icahn has amassed a sizable stake in Caesars, according to people familiar. The size and Icahn's intentions not completely known. I think he also talked to CNBC maybe a little bit about this. So anyway, this stock definitely popping in today's session. Zscaler, we've been worried about some of the software space. Well, this is a company that plays into the cybersecurity world. This one surging about 8.5% in today's session. This after the company did beat estimates. It also raised its full year forecast. Demand for its platform grows. And as we head into the weekend, a little bit of beer news. Sam Adams, Boston Beer in talks for a possible sale to Suntory. This is according to the Wall Street Journal. So this name did surge to a record, at least intraday, finishing on this Friday with a 22% gain.
All right, some gainers. I got some decliners. Dell, we got to start with Dell, falling 18%. It actually fell the most since its return to the public markets back in 2018. We covered the numbers yesterday and the stock reaction as well. The first revenue increase since 2022 was not enough to impress investors. Those investors had really high expectations for the company's AI server business. For example, the backlog for Dell's AI servers, these are the ones that are powerful enough to equip or to handle artificial intelligence, increased more than 30% quarter over quarter, but investors wanted to see a bigger backlog. Shares of Moderna falling by 5.9% today. They fell after the FDA approved the company's RSV vaccine for adults aged 60 and older. Here's why, though. Analysts came out and said that data in the FDA's label for the vaccine highlights a weaker effectiveness compared to its peers. So despite the FDA approval, the shares fell. MongoDB shares under pressure since reporting earnings yesterday. Shares falling today by 24%. The shares fell as much as 27% earlier in the session. Had it closed there, it would have been its biggest fall ever. Shares did close off their lows, so just the worst day going back to September of 2022. The software company cut its full year forecast. It's just the latest in a series of disappointing results from software companies. Think about what we saw from Salesforce yesterday. Last week, Workday saw its biggest sell-off since 2016. And also worth checking in on DJT, Trump Media and Technology. The shares were all over the place today. They did close lower by more than 5%, but they did swing between gains and losses. This after a New York jury found the former president guilty of 34 counts of falsifying business records. But the share movement wasn't clear in terms of what investors were thinking, because it was higher, then it was lower, then it was higher, then it was lower.
That is a pretty accurate response.
Yeah.
I appreciate that. Let's go to the bond market for a second, because we did see a bid. The 2- and 5-year hit a session lows at this month-end close. It was really the belly that got the outperformance. But interestingly enough, a 10-year yield for the whole month at one point was down 37 basis points. It ended about 17 basis points was the most that it moved this month. But it just shows that the selling that we have expected doesn't always materialize. We definitely see a strong bid around. We were talking to somebody earlier about the fact that when you have an auction, you tend to buy after. And we definitely wind up seeing that kind of volatility and that whippiness in the bond market, guys.
All right. So as we get ready for the weekend, we're thinking a little bit about the Olympics that are coming up in Paris this summer. And on that, for the first time, they're going to actually have a beer sponsor for the Olympic Games. We're talking about Anheuser-Busch, and already bottles are rolling off their production lines in Belgium for the upcoming games. And what's interesting is these are non-alcoholic beers.
Yeah, so we've been talking about this for a few years because we've had the founders of Athletic Brewing on the show, and they're actually quoted in this story. But the rise in non-alcoholic beers has been pretty huge over the last few years. It still is tiny in comparison to beers that contain alcohol, but you'll notice that the marketing for non-alcoholic beers is so much different than it was just a few years ago. And indeed, more and more people are buying them. And it's also available at more and more restaurants now, whereas just a few years ago, you couldn't find this stuff anywhere.
Tim knows so much about this.
It's what I drink.
That's what he drinks.
Yeah.
Yeah, I mean, I don't really drink that much anymore either. Ever since I had long COVID a few years ago, and I do a lot of mocktails and stuff at restaurants. And man, those mocktails are like $20. First of all, they're good, yes, but they're like the same price as a regular cocktail, which is the same thing as like a non-alcoholic beer. And you're like, wait, why am I paying $20 for non-alcoholic beer?
Yeah, it does add up still, but it's nice to actually be able to drink something,
You know what you don't want to drink?
What do you not want to drink?
The Seine.
Oh yeah, good.
Oh,
good
you
segue.
you don't even want to swim in it, actually. So this is a great story that came, well, not for if you're an Olympic swimmer, but apparently the Seine is not ready yet for the Olympics. Its levels of E. coli is basically too much, and that basically is a sewage situation. So you've had officials spend, over €1 billion, I think, on it, on the sewage issues, and it hasn't worked.
Well, don't worry. They still got, like 6 weeks to get it all together. So I don't know how long it takes to clean up a river, but I mean, this was something I remember they talked about during the trials here, and it'll get to the point where I don't know, either we're going to swim in a dirty river, or I guess we're going to swim in a vat of whatever the heck Tim likes to drink. I'm just a little confused, Tim, but you kind of threw me for a loop there. Okay. I mean, we all know you're the healthiest person on this network, or at least on this show right now. What's the appeal? I mean, if there's no alcohol to give you like a buzz or get drunk.
That's a good question.
Then, you just like the taste?
A couple things. Yeah, I do like the taste of an IPA, and there's one company that makes an IPA that kind of tastes like I like the taste of beer. I like drinking a beer. I just don't like the way it makes me feel when I drink a beer. Yeah, you can, you're out with friends on a hot summer day. It's nice to be able to drink something that's not water, but also, not going to make me feel a little loopy.
Okay, I don't. That doesn't compute with me for sure.
You're going to Paris, you better drink wine. I'm just going to say.
Oh, yeah. Are you going to Paris and not drinking wine? No, you can't do that. It's just sad.
And then if you drink wine, you might jump in the Seine. Like maybe. I don't know. Or
Don't
maybe
do that.
not. All right, guys, that's a wrap. Have a good and safe weekend. Enjoy it. It's supposed to be, I think, a gorgeous one. That is our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell. We'll see you on Monday.
All right, a lot more coming up here on Bloomberg Television. The close continues here Beyond the Bell. As we push ahead here to some of the big events, including a big election in Mexico, Kristina Hooper, Chief Global Market Strategist, going to be joining us in just a second. This is Bloomberg.
Welcome back to The Close. I'm Alex Steele. Happy Friday.
And I'm Romaine Bostic here as the markets close out the day, the week, and the month. A quick look here to some of the price action in S&P, a NASDAQ, and a Dow that all spent a good portion of the day in the red, pushing into the green as you got closer to the closing bells. Gains on a weekly basis, though? Well, no. Not for the NASDAQ and not for the S&P. 5 straight weeks of gains coming to an end, though the monthly gains did hold here on this Friday afternoon. Alex, but a flip-flop in that trade. It wasn't tech this time around that was really leading the party. You saw a lot more juice this week out of, believe it or not, utilities, energy, and retail.
Yeah, I believe that. What's interesting is we're trying to find like a real comprehensive narrative, and it was hard to find it this week, which means all the individual movers become a little bit more interesting. Like Caesars, for example, Carl Icahn taking a stake. That's not an activist stake. That stock gets a nice pop. Gap, earnings crushed it. It really seems like their ability to bring in Zach Posen has been quite helpful, and they're doing a lot of publicity with Anne Hathaway, for example. That stock up a whopping 28%, even though the consumer is struggling. And then Moderna, that's a totally random scenario as well. That stock was higher as FDA approved its RSV vaccine for older adults. And analysts came out and said, you know what, guys, maybe it's not as effective or more effective than its competitors, and that stock is down. And I just bring that all up because it shows the idiosyncratic stories are really what's moving underlying the market, even though on the surface, overall markets may not be that exciting. Which brings us to the top story of the hour. And that last hour trade was actually kind of exciting. Volatility makes a comeback. After dropping almost 1% amid a sell-off in tech mega caps, the S&P 500 rebounded to close with its biggest monthly advance since February, Romaine.
All right, let's go to another big story that's unfolding this weekend here. Folks in Mexico are going to go to the polls this weekend to elect a new president. The winner will face a host of economic challenges, including a lackluster growth, currency valuation, trade frictions, and infrastructure needs. It's a laundry list of issues for whoever that next president will be, and maybe a laundry list of issues that investors will have to deal with. Kristina Hooper is joining us right now. She is the Chief Global Market Strategist over at Invesco, and she joins us here in Studio One in New York. And Kristina, I remember I was actually down in Mexico when AMLO was elected back in, 2018 here. There was a huge amount of activity that we saw in markets around the Mexican peso, but even around stocks here in the U.S. We're not necessarily seeing a repeat of that in the lead up to this. Could that change after Sunday?
I don't think so. And, a few reasons why. First of all, Scheinbaum, who is in the lead, is perceived to be the heir to AMLO. So very much carrying on those same policies. And so no real change. I think when AMLO came in, there was expectations of significant change and a fair amount of uncertainty along with it. And then beyond that, I think that what is dominating markets more today is what's going to happen with central banks, and in particular, what's happening with the Fed.
This gets to a question, though, and I just want to stick with Mexico here, too, because I'm curious about the relationship between the U.S. and Mexico. I mean, obviously, we're natural partners given our proximity to each other here. From an investment standpoint, is there a play there? Is there something there where you would say, okay, how can I benefit as an investor from that relationship? Or for that matter, if you think the relationship is going to sour, how do I protect myself?
So absolutely. What we're likely to see, though, is what happens in Mexico, especially in markets, is going to be dependent on U.S. policy, exactly what happens in terms of more tariffs, more trade restrictions that could benefit indirectly Mexico. But beyond that, when the Fed cuts, I think the Mexico Central Bank has been very, very careful. They cut once and they're sitting and waiting because they want to maintain that very significant spread between their key rate and the Fed funds rate. So I think those are kind of the key factors that will dictate what happens. But perhaps most important is going to be that reacceleration in the U.S. economy. Right now, we're seeing an economy that's under pressure. But if the U.S. were to, and it's certainly doing fairly well, been quite resilient, but if the U.S. were to reaccelerate, that would be huge for Mexico. When the U.S. catches a cold, Mexico arguably catches pneumonia. But the reverse is true as well. The opposite is true in that you could certainly see Mexico do very well if the U.S. reaccelerates. And I think there's real potential there no matter who wins this election this weekend.
Well, I'm glad you brought that up because there's two real catalysts. One is the nearshoring that was already taking place, and the other are trade tariffs now put on China, which now make Mexico and Canada all the more important to secure supplies for things like EVs, batteries, etc. What is the growth potential for a country like Mexico? And is it ready for that kind of investment and that kind of growth and that kind of potential inflation?
I think it is. Certainly, Mexico has had some time to prepare. We're in about year 6 of tariff wars, right? And certainly the kinds of restrictions placed on trade, Mexico's become quite familiar with and recognizes that it is the beneficiary. So I think one of the key issues now, and certainly we've seen this in the campaign, is how do you handle issues like crime and how do you become more business friendly? Right. And clearly the opposition party has a stronger case for that. They've been very, very critical of things like AMLO's policy of, I think it's hugs, not bullets, and not combating crime straight on. So a very different approach, a more business-friendly approach could certainly be a positive, but I don't think it's a make or break situation. No matter who's in power, Mexico's poised to benefit more, and I think it's going to be ready to benefit more. How much more, though, really depends on the policies on the margins.
When you talk about the U.S. economy reaccelerating and then the trickle down to, say, in Mexico, do you think we could reaccelerate? And what does that look like?
So I think we could very well reaccelerate. Right now, we're taking on more risk the longer we keep the Fed funds rate at current levels. You know, if we think about 93, 94, the Fed kept the Fed funds rate at its peak for about 5 months before starting to cut. We're now getting very close to a year. So every day, the long and variable lags of monetary policy, those risks increase in terms of sending the economy into recession. But I think we're going to very well be able to avoid recession. I think a reacceleration occurs when we start to get rate cuts. All we need is one, I think, to change a lot of the psychology around the economy, but also improvement in real income. When wages improve, inflation-adjusted wages improve as disinflation continues, I think that'll also be a catalyst. So I think that combined, an easing of credit conditions will enable the economy to reaccelerate probably by the end of this year, maybe the start of next year. And so I think that provides a really nice macro backdrop that should be helpful to Mexico.
All right, Kristina Hooper, always great to talk to you. Kristina Hooper, Chief Global Market Strategist over at Invesco. A closer look, Alex, here at the election this weekend. And we should point out, at least based on the political punditry out there, this is kind of a foregone conclusion. Everyone says Claudia Sheinbaum is a lock to win. I just want to read a quote that's in our story because it jumped out at me. It would take a meteorite of the kind that killed the dinosaurs for Sheinbaum to lose. Okay,
but that's putting a cart before your horse, though. I mean, when you say that, I'm always going to take the opposite.
Yeah,
and say,
and we should point out the person who said that is the head of the main political party that she's a part of. So obviously they have a vested interest in there. But as Kristina was talking about, I mean, she's obviously a disciple of Andres Manuel Lopez Obrador, and she'll probably continue a lot of the same policies. So if you like AMLO, then why wouldn't you vote for her?
Yeah. No, I agree. But remember when we said that about President Trump being President Trump? No one ever. Too soon?
Too soon.
Okay.
All right, we're going to talk about another big event on Sunday, and that is something I know you've been keeping an eye on, Alex. That OPEC Plus meeting here. Discussion still going on right now about whether to curb some of that activity. We're going to talk about the potential impact on oil prices. That's coming up next here on The Close on Bloomberg.
So we're watching Mexico's elections. We're also watching the OPEC Plus meeting that is now in person on Sunday. It was pushed back and went from virtual to in person. They're going to gather in Riyadh to debate oil output cuts. They reportedly discussed prolonging those supply curbs to the end of this year, potentially into 2025. Joining us now is Daan Struyven, head of oil research over at Goldman Sachs. Daan, great to see you. Thank you for coming in on a Friday. What do you make of the fact that they went from virtual, no big deal, to now in person in Riyadh? What does that tell you about the meeting?
Yeah, happy Friday. So it doesn't change our base case forecast that the cuts, the voluntary cuts, will be extended into the second half. I think at the margin, it could trigger two changes. One, maybe a greater focus on compliance and a greater focus on the implementation of the so-called compensation cuts for imperfect compliance previously. And second, perhaps there could be perhaps a press conference in person and a more cohesive, synchronized communication. I think the market did not rally despite surprise cuts at the November 2023 meeting, in part because the communication was not very streamlined.
I'm also wondering, too, what Saudi Aramco issuing $10 billion worth of shares has to do with it, and also what is the contango that we just saw yesterday in the Brent spread. So basically, the first month is lower now in prices than future months, and that can signal more supply or less demand. How do those two things, you think, change the calculus?
So the fact that now you saw a prompt contango for Brent, I think.
Who doesn't like prompt contango on Friday at 4:23?
Which basically means that buying oil today is slightly cheaper than buying tomorrow, which is typically consistent with some oversupply. I think that strengthens our conviction in the base case that the voluntary cuts will be extended, despite the fact there's already a lot of spare capacity. In terms of your other question, sorry.
The Saudi Aramco. So they're going to sell shares, and I wonder how that's playing into it. I mean, oil was at 66 when it IPO'd to begin with. But
media reports suggest that the decision to issue roughly 0.6% of the Saudi Aramco shares has been taken about 3 months ago. So I think the timing is probably a coincidence.
Yeah.
What it does suggest is that with Brent crude oil prices sort of very much in the middle of our 75 to 90 range, which is below the Saudi fiscal break-even price, which we estimate at just above $100 per barrel, that there will be a need for Saudi Arabia to borrow, go to markets, or issue equity to fund the very ambitious ongoing Vision 2030 plans.
All right. Can we go back to the oversupply issue and the contango that we're in, mainly because, you know how many years it took me to remember what contango was.
I still look it up sometimes.
Contango, that's how I remembered it, Alex.
Anyway, steal that.
Dan, we don't want to bore you with our silliness here, but it gets to an issue there. Where is the oversupply? I mean, we know it's here in the U.S., and I guess we can probably speculate it's also coming out of Russia. But what other countries and regions are we also seeing significant oversupply?
Yeah, so we estimate that over the last 3 months or so, global oil markets have been building inventories by about 900 KBD, so moderate inventory builds.
Yeah.
I think it's a combination of upside surprises to supply. In February and March in the U.S., we got a pretty strong supply number that was released today for the U.S. in March. And also ongoing upside surprises on the supply side in what we call the sanctioned producers, in particular Iran and also Venezuela. And then also on the demand side, we are seeing overall resilient demand, but pockets of weakness, in particular in diesel markets and also in China. I think which is in contrast with transportation fuels, where demand is solid. We actually had the largest number of U.S. airline passengers over the Memorial Weekend day on record.
And you see that continuing, meaning some of those demand issues that have sort of helped to keep the market stable and keep prices elevated. Will that continue for the foreseeable future?
Yes, that's our base case expectation. I think one striking fact is that roughly 70% of global oil demand depends on the services sector, and the consumer, as opposed to the goods sector and the industrial sector. Intuition is that transportation fuels account for 60% of global demand. And we are convinced that the consumer in DM markets remains in a healthy shape. And in fact, in DM markets outside of the US, the consumer picture is improving with pickups in real incomes in places like Europe and Japan.
All right. Well, I did my part. I just bought an airline ticket last night. So I'm trying to do my part here to keep oil prices up. Dan, great to talk to you. Daan Struyven there, head of oil research over at Goldman Sachs, ahead of that OPEC Plus meeting taking place in person, Alex, Zeal, which, I don't know, I kind of love the entertainment value of seeing them all on that crazy Zoom screen.
Oh, you do? No, I like it in person.
And where they would always be on mute and they didn't understand. And I was like, this is how like collusion is done?
So this is a great combo, but I want to know more about what you did for backwardation. So if contango was like contango.
But you just got to remember one. Contango, I see. In like, it's going up. And then obviously the opposite would be backwardation. But that's how I remembered it. And it took me, you know who taught me that, by the way?
Who did?
Shout out to Taylor Riggs, our former colleague there. Love you, babe. We'll be back in a moment. This is Bloomberg.
So autonomous plants, autonomous buildings, autonomous planes, this is all part of our fundamental technology roadmap on what we are working on every day.
Vimal Kapur there, that's the CEO of Honeywell. We had a chance to catch up with him yesterday about the future of autonomous technology. Now, right now, here on this day, in today's Next Up segment, we're going to hear more about a company taking that tech to new heights. Gather AI is its name, and it uses its software to power drones that monitor inventory levels at warehouses. Retailers and manufacturers can use it to monitor the quality of food and beverages, cut back on excess inventory, and even to reduce shrink. Here in studio with us right now to talk a little bit more about this is Sankalp Arora, co-founder and CEO of Gather AI. Great to have you here on the set, Sankalp.
Pleasure to be here.
Let's talk about this technology here. First, just to be clear here, you're making the technology that goes into these drones and not the drones themselves, or is this all sort of put together as one package?
No, so we don't make the drones at all. Unfortunately, robotics is at an inflection point where you can use off-the-shelf hardware and make it autonomous and do useful things.
So what does your software then bring to the table for those end users with those off-the-shelf drones?
So I'll go to the problem we solve. Because now most of the retail movement is happening in e-commerce. And let's say you order a pair of shoes and you click buy on the website and they don't arrive at your house because for whatever reason, they didn't find it in the warehouse. More and more of those units are actually moving to warehouses to end customers instead of retail stores. And more of those units are getting lost. So that's what we do, where we make drones autonomous, curious about boxes and barcodes, so they fly around in warehouses, take inventory, making inventory taking 15 times faster than it typically has been. Which means if I'm a warehouse worker, I don't have to find the pair of shoes you ordered in 500,000 shoes that are in the warehouse. I can just look up in the system where they are because the drone has scanned it and get it to you.
Is that in conjunction with a worker? So does that replace the worker, or is it the worker working with that software and with the drone that helps make all of this possible?
It's the worker working with it. I like to say we make people superhumans. So before us, a person would usually take 60 items per hour and take inventory of it. With us, they can take up to 900 items per hour.
Oh my gosh.
And keep scanning. So really, in an industry that is facing 70% attrition rate, people doing really hard jobs, we just make their jobs a little bit easier.
And what's your relationship like? What's it like with customers? Like getting your pitch out there, getting meetings? How is that evolving right now for you? Who are you talking to?
It's been, actually, we are deployed in a few of the leading 3PLs in US, like NFI, Geodis, some of the largest retailers in the world, which I can't name. But we have had results where we dropped their inventory inaccuracies by 60%, where we get their warehouses up to 99.9997% accurate. And all of this turning their facilities from reactive, where they were finding stuff, to proactive where they know where everything is.
Sankalp, we always ask a lot of the folks who come on this segment about this idea of sort of what your moat is. That was sort of course, always the famous Warren Buffett sort of euphemism for how do you sort of protect what you have and this idea that you've come up with from competitors, particularly more deep-pocketed competitors, that if they see the success of this, they'll say, well, why don't we just do it ourselves?
Yeah, that's a very good question. The tech is hard. Mm-hmm. The team that we have assembled is a team of robotics and AI experts that has been working on it for the last 15 years. Mm-hmm. I was fortunate enough to build the world's first fully autonomous helicopter, and sort of that tech transferred into this. But, and I think the main moat is that we have spent hours and hours and months in warehouses marrying deep tech with actual use case.
And so when we talk about the growth of this company and sort of what's next here, you plan to stay a private company?
For the short term, I think long term, the idea is to go public and go big, and mm-hmm. I can share why. Mm-hmm. What's happening in supply chain right now, in visibility, is similar to what happened in 80s and 90s when barcodes came around. Because barcodes seems like they have been there forever, but they haven't. In 80s and 90s, they transformed supply chain visibility. But e-commerce wasn't a thing then. Now we need new tools to keep up with e-commerce, and we have ubiquitous cameras, where cameras can offer you much more traceability on whether my inventory is damaged, what is my count, where it is located, what is its status, other than just a barcode. And this is right at an inflection point, and we find ourselves at that inflection point, leading the term where drones are collecting these images, and we are training our AI on it every day, and it's getting better, which means we can lead that revolution.
All right, Sankalp. Well, this is very fascinating stuff. Sankalp Arora, he's the CEO and co-founder over at Gather AI. And Alex, I mean, this has been all the talk really about how you sort of make these warehouses and these other facilities. I mean, when I heard him talk about 60% decline in inventory issues, I mean, if you're a retailer, that would be huge if they can really deliver on those types of numbers, because that's always the bugaboo, right? I mean, you talked about the 500,000 pairs of shoes or whatever it is. I mean, I have like 10,000 in my closet at home, and I don't know how you find all those. I can't find them in the morning myself.
You need your own personal drone with software in order to do that.
I would like one, actually.
Yeah, but that also dovetails with what we spoke about with the Honeywell CEO too, that is no way about replacing workers, but like you don't need two people maybe to do one job. You can have a drone and then a human, or that you need the human to be able to participate with the drone. The two together is the magic. It's not the replacement.
All right. I just hope this is going to be used for good and not evil.
Well, in your shoe closet, I'm assuming that's good. I'm assuming the shoe closet's a good thing.
All right. We do want to stay here in this space here and get some more perspective from the folks actually funding the startups here. Our next guest does just that, but with a particular focus on businesses that strive to have a positive impact on different communities while turning a profit, of course. That once niche corner of finance called impact investing has swelled from just really kind of like about a $10 billion industry just a little while ago to more than $1 trillion allocated today. Here in studio with us right now is Nasir Qadree, founder and managing partner of Zeal Capital Partners. Nasir, great to see you here in studio.
Great to see you, Romaine. Alex, great to be here.
This is fascinating what you do, because when we always talk about impact investing, companies kind of have this on the side. They're doing kind of just regular investing or whatever you want to call it, and this is kind of an add-on. Your firm is basically 100% all in on impact investing. Explain why.
Absolutely. So at Zeal Capital Partners, we're laser focused on backing exceptional, diverse management teams that are rethinking the building blocks of wealth, from employment pathways to financial inclusion with a lens towards technology, and now health equity. And when you think about the role that fintech plays, the future of work and learning plays in healthcare, it's directly tied to turbocharging economic mobility across the country and at scale of the globe. And so we're laser focused, and we do this through our investment mandate called inclusive investing, a 5-pronged market-back approach that we believe it should be the gold standard, whether you are a storied franchise or an emerging manager.
This isn't just about, though, investing in sort of minority and underrepresented founders. But this is also making sure that what they're building, the products and services they're creating, will have an impact for some of those communities. Explain in detail some of those. So I know you're involved in fintech, the idea that that could help close the wealth gap. You're involved in healthcare, the idea that there's a lot of issues in the healthcare space that also creates a lot of inequities, and also in workforce. You can take any one of those. Let's just do one of those and explain how that works.
For sure. So last year, we decided to scale our investment mandate to health equity, right? And you think about the role that, disparities that exist across the healthcare sector. You have a focus around access and affordability of healthcare, thinking about the role that technology can play as it relates to women's and maternal health, mental health and wellness. We saw that a lot during COVID. And then my favorite is SDOH, social determinants of health, other factors that yield poor health outcomes like food security and transportation and housing, for example.
So how does your investment help with that?
So one, we are, we not only add capital to these entrepreneurs, but we build a customized system of support, a portfolio framework that allows them to not only have the liquidity to get to that next stage of growth, but also recognizing governance and sales and go-to-market strategy, even collaborating with them around what type of impact metrics are you capturing. One thing I love about investing at the early stage is that you get to be part of a company, and as they grow, their impact is ingrained in their vision and in their company, and so that to us is exciting to add that additional.
And you're primarily doing seed stage, is that correct?
Yes. So way below the capital stack, pre-seed into Series A.
Gotcha.
How competitive is that landscape right now? I feel like if I just lump excuse me. If I just lump it, go take it.
I don't know what her question is, so I'm going to ask you a different question here while Alex catches her breath here. But it gets to the question, though, too, as to about sort of how you grow these businesses, right? So you're going in very early. So these companies, they need more than just money. They need maybe a little bit of hand-holding. So explain, is there a sort of a network of support either within Zeal or are you partnering with folks that can sort of help these companies?
Absolutely. So we've developed a strong track record to really understand, as we think about our sourcing strategy, right? And so part of our inclusive investing strategy allows us to earmark our traveling dollars, not just our capital dollars, but our traveling dollars to understand what's happening in these overlooked markets. So from Des Moines, Iowa to Detroit to Houston, Texas, in our own backyard in Washington, D.C. And so when we think about sourcing these companies, and Barclays, that partnership is a great example, giving us the ability to underwrite. This is a $50 million allocation to focus on Black entrepreneurs, and we know last year particularly, it's been a huge disparity in terms of funding for them.
Just real quickly, though, have you seen pushback on this? I mean, as you know, everybody was on the DEI bandwagon after in the middle of 2020, and we've seen big corporations and some other folks kind of pull back from that. Have you faced any resistance?
I firmly believe, Romain, that we cannot discount the role that equity plays across the private markets. And so I believe that we are in a redefining moment as you think about, we call this a Renaissance era. You have a number of diverse and women-led venture capital firms, even further up the capital sector, are being formed. I think that's great for liquidity purposes. You see more founders that want more diverse entrepreneurs, diverse fund managers on their cap table. And I think that's great for the economy as you think about job creation.
Yeah.
That was my question.
No,
you got there.
You
said it differently, but that was
that
was my question.
It's like the mind melt.
I was coughing my guts out. All right, Nasir, thanks a lot. I appreciate you being here. Nasir Qadree, founder and managing partner of Zeal Capital Partners. Let's take a check-in here on where markets closed on today. We definitely rallied into the close here. It was a nothing burger all day, and tech was down about 1% at one point, and now tech ended flat. The S&P was up by 0.8%, helped by energy stocks. Outperformer really led by some of the refining stocks as well as big oil, and Caesars truly outperforming here. Best performing stock on the S&P as Carl Icahn takes a non-activist stake. This is the close on Bloomberg.
Welcome back. We're turning back to politics right now. A closer look, of course, at the verdict out of that hush money trial for former President Donald Trump. And the former president actually raising a ton of campaign cash off of it following that guilty verdict. Bloomberg's Balance of Power co-anchor Joe Mathieu joining us right now. Talk a little bit more about this. And Joe, I guess I shouldn't be surprised, but as soon as this verdict came out, I mean, there were emails going out asking for donations. Not just the Trump campaign, but the Biden campaign also sent out theirs asking for donations on the back of this as well. I'm not sure what the Bidens raised, but Trump, $35 million in 24 hours. Is that right?
Pretty amazing. That's correct. Even less than 24 hours. 34.8 is the number that we got from the campaign today, Romaine. That's $1 million for each guilty count. If you look at it that way, Donald Trump said at Trump Tower earlier it was closer to $39 million. If we're to believe that,
of course,
this is double the previous record that we've seen. And these are small dollar donations online. So take that here and couple that with the news of the past week or so. The Adelsons, right, the Schwartzmans, the Ackmans of the world, the big mega donors also gravitating toward Donald Trump makes you think that this has done nothing but help his situation, financially at least.
Well, before we get to the mega donors, too, I thought that was one interesting complexion to this. I mean, not only the small donors, but they also, again, if you believe what the campaign put out, they're saying that a good chunk of this, like a third of it, were first-time donors as well. And I know that was kind of a knock on the Trump campaign for the last few months, that he wasn't pulling in that sort of up from the ground grassroots type of money that was kind of the hallmark of his campaign in 2015 and 2016.
This is true. It's an important moment for him, remembering that just last month, Romaine, the Trump campaign and the RNC outraised Joe Biden and the DNC for the first time in this cycle. That was April. Now look at what we're going to have in this month and what we could be talking about in June with the first debate. But this is going to be an awfully complicated summer, of course, with trying to pick a vice president, hold a political convention, and deal with sentencing potentially involving incarceration. But look, he's calling himself a political prisoner. That image was ready to go the minute the verdict was reached, and he's going to double down on this to the extent that it helps him kind of exercise the martyrdom effect politically.
And President Biden had stayed pretty far away from all of this. He did speak today, and in his speech, he talked about President Trump, former President Trump. Here's part of what he had to say about the outcome.
The American principle that no one is above the law was reaffirmed. And it's reckless, it's dangerous, it's irresponsible for anyone to say this was rigged just because they don't like the verdict.
So is the backlash, will there be a backlash to Democrats also?
Well, I'll tell you what, we're going to show you something coming up in Balance of Power. The Trump campaign has already turned a moment from that news conference into a political ad, and it's very effective. When Joe Biden was leaving, a reporter asked him about accusations of this being a politically motivated trial. Donald Trump says it's Joe Biden behind this. He turned around and smiled and did not answer. He just gave that Joe Biden kind of smirky smile and left the room. They have taken that image and put very dramatic music behind it to make it look like that he, of course, is loving this, laughing about it, and the conniving man behind the curtain. But then again, he says that Joe Biden can't string two sentences together. So I'm not sure which character they always want us to be thinking about here.
Yeah, me either, Joe. But it gets to a question, though, too. I mean, I know there was a lot of talk about not making this trial or any of his other trials into political issues. And, of course, Trump has made it a political issue. Biden has made it a political issue. You have a sentencing date for Trump that comes 4 days before the Republican nominating convention. So I'm pretty sure we're going to hear a lot about this on stage at that convention and maybe even at the Democratic convention in August.
Absolutely, yes. Remembering that he refers to the January 6 rioters as hostages. They are supposed to be part of that convention, by the way. The January 6 choir, as they call it, will likely be on stage.
A choir?
Donald Trump has something in common with them now as a convicted felon. And if you kind of take this theme a little bit further, he's been selling shirts with mugshots on it. This has become a central theme of his campaign, and it's packed with anger by Republicans. Lawmakers will be back in town next week. Romaine, just wait for the hearings. Judiciary, oversight, and the weaponization, what they say, of government here. Wait for criminal charges to be referred to Joe Biden. We're just getting started.
I cannot wait. I'm going to put all those on my calendar, Joe, so I know which days to take off from work. Joe Mathieu, though, will be here on all of those days, along with Keely Lyons. They are the co-hosts of Bloomberg's Balance of Power. You can catch them every day at the top of the hour, 5 p.m. Washington time, right here on Bloomberg Television. Meanwhile, right here on the close, we still got a ways to go here. We're going to set you up for some of the big potential market moving events over the next week. This is Bloomberg. All right, let's push ahead to hear some of the potential market moving events over the next week or so here. And we start this weekend, actually. Boeing actually going to launch the Starliner here. This is like 10 years in the making. Remember, they had this contract with NASA. I think they got back in 2014. They've had a lot of delays, a lot of mishaps. This is that crewed taxi that's supposed to take people from Earth to up to the space station.
So wasn't this launch delayed like multiple times already just in the past month?
Yeah.
But for real this time it's going to happen?
Well, that's what they say. They still have a helium leak problem, but they're now saying that they can still go ahead with it even with that helium leak. We'll keep an eye on that. And I know you're keeping an eye as well on what's going on with OPEC Plus.
Sorry.
OPEC Plus, a big meeting this Sunday where they're expected, of course, to discuss their output. And we'll learn a lot potentially about supply and demand. We had a chance to catch up with Daan Struyven a little bit earlier here. He seems to think this could be incremental, but longer term, maybe some supply and demand issues that folks are going to have to sort out. We also get a lot of earnings next week as well. We're kind of in that phase of the earnings cycle, though. We're kind of really second and third tier here. But maybe a couple companies that could provide some insights, including HPE, Hewlett-Packard Enterprises, CrowdStrike, as well as Five Below and Victoria's Secret.
Yeah, I don't know about that one, Victoria's Secret.
Yeah.
I mean, it was going to make a turnaround.
Is that a turnaround story?
I don't know. Or is it still in the bottom of the turnaround? Hard to say. Also, Thursday, we get the ECB meeting. They have telegraphed this hardcore. This should be the first rate cut in 5 years, moving before the Fed. The question for the ECB, though, what happens after? Just because they start cutting doesn't mean they're going to continue to cut, and everyone's kind of been really cagey about that. So that's going to be quite interesting to me.
Yeah, absolutely. And of course, the big show here in the U.S. is going to come on Friday with the monthly jobs report here. This could be critical, particularly coming off of the last couple of inflation reports that was very encouraging here. Or is that encouragement going to show up in the labor market data?
Yep. And will it actually move the markets, or will it be a snooze fest?
Thanks for joining us this week here on The Close. We'll be back next week. In the meantime, stick around. Balance of Power is coming up next on Bloomberg.